When to exit and re-enter the crypto markets. A popular question amongst cryptocurrency investors is how they can determine when to exit the market and re-enter at a lower price. The fundamental issue with such a question is that it is usually due to the investor having a short-term outlook that sabotages their ability to make objective decisions. They force their biases or opinions on what should happen in the market instead of allowing the market to tell them what could potentially happen. They listen to the words of influencers who have a conflict of interest and have excessive trust in what other people have to say. They allow greed to take over, which causes them to miss out on prime opportunities to take profit due to unrealistic price expectations, and then they refuse to buy the bottom because they expect further decreases in price. That being said, how can you navigate the market without falling victim to the common mistakes most investors make? How can you have any grasp on what is going on in the markets? In this video, we will go over several things you should consider when determining when to exit and enter crypto markets. At the end of the day, the only person who you can trust is yourself. These tips will provide some guidelines for you to observe what is going on around you so that you can best determine your own personal investment strategy. Gauge retail sentiment. A great way to get a feel for what is going on in the markets is to gauge retail sentiment. You can scope the views of market participants on websites such as Twitter, Reddit, and YouTube. Try to see past the biases people have that force them into certain views. If someone has recently gotten wrecked by going long at the top, they will tend to have an overly bearish bias. They will want the price to go down further so that they can profit off of a short. What you must realize is that the majority of market participants are reactive. They fail to predict the future and shape their biases based upon what has already happened. This is why they hardly succeed. On the other hand, you must be careful of influencers and market participants who have a conflict of interest or are deliberately perpetuating misinformation. They will often tell you the opposite of what is going to happen on purpose so that they always have liquidity for their trades. As they shill certain coins to their followers, they simultaneously dump it on their followers while saying that we're all going to make it. Such influencers are frauds and are excellent people to counter trade. Keep in mind that certain influencers are perma-bulls or perma-bears, so there is a possibility that they could be right at certain times. The important thing to realize is that the prevailing narrative is wrong most of the time. The hardest part of investing is being able to filter through all the noise and avoid all the distractions that blind you from what is going on. Watch out for outlandish predictions. You may notice that once prices begin increasing rapidly, and especially when they are going parabolic, that many people begin predicting what prices assets will reach. These predictions are often unrealistic and have no technical analysis or fundamental analysis behind them. They are simply created by influencers to generate hype and manipulate people into purchasing. In a bull market, these numbers sound amazing to the retail investor because they believe they can get rich quick. In a bear market or trend, the targets become unreasonably low, which also entices the greed of retail investors because they believe they can get their coins at rock bottom prices. What tends to happen is that neither of these targets are met. This is because the market is simply the sum of all the market participants. If all the market participants expect a $100,000 Bitcoin, which was the case in 2021, the chances are that it won't happen. If all the market participants expect a $20,000 Bitcoin, the chances are that things won't go their way. It is imperative to realize that price projections are merely designed to mislead retail investors into investing in things they otherwise would not have. In the bearish case, unrealistically low price projections can manipulate retail investors into selling their coins at a loss, which the whales will then absorb. The game is brutal, which is why it is important to stay vigilant. Hold multiple long and short positions. It is not a good idea to try to time the markets. The chances are that you will fail. Hedge funds and professional traders do not try to time the markets but instead hedge for multiple scenarios. They trade in a variety of position sizes in different time horizons amongst different asset classes. Most retail investors tend to trade in large position sizes over a short time horizon in a single asset class. Retail investors do not hedge their risk and are likely to YOLO their savings into a hunch or bet that they have. They are either all in or all out. This is the opposite approach to how the professionals operate. Professionals trade on shorter time frames but also have long-term holdings at the same time. They own stocks, bonds, cryptos, precious metals and currencies at the same time. This is because they are in it for the long run, as opposed to retail investors who want to get in and get out. It is no surprise that the professionals need retail investors in the game in order to profit. To succeed as a retail investor, you must be different from the herd. You need to take a unique approach that is not talked about by the rest of your peers. You must be able to weed through the lies and distractions that come your way. You need to think for yourself and not trust a single word that you hear from someone else. If you liked this video and found it educational, Make sure to like this video and subscribe. I'll see you in the next one.